to 𝗥𝗵𝗲 show. Thank you for joining us each and every morning. You know what? 80% is showing up, and you guys, you show up because you want to improve the quality, you want to improve the success in your life and in business. And that's what it's all about. You could be at work, you could be doing anything, but you are tuning in to us because we always want to give you value. And today, my amazing co-host, Ria, is going to be taking over the conversation. So I want you to get your notepad and pens, take notes, what she's about to share. So before I bring her on, I want to welcome you all, even the new members who have joined, welcome. And my name is 𝗥𝗵𝗲.
My name is Ria.
And welcome
to
our
show.
Ria, I'm going to pass the mic to you.
Thank you, 𝗥𝗵𝗲. Today's topic is from the book of Robert Kiyosaki, Increasing Our Financial IQ. And that is financial IQ number 4, which is leveraging financial IQ number 4. And I have 16 points that I'm going to be sharing with you guys. So first point is focus and not diversification. Like we are told by Wall Street, diversify our eggs. Focus, according to Robert, is the key to more sophisticated leverage. This means higher returns and lower risk when you have the focus. Second, focus, it requires more financial intelligence. Third lesson that I learned is that financial intelligence begins with knowing what we are investing our money. Fourth lesson is that in the world of money, there are two things that investors invest. And these two things are capital gains. Second would be cash flow. I'm going to talk about capital gains, and I'm going to talk about cash flow. So the fifth lesson I learned is about capital gains. According to Robert, capital gains is another reason so many of us, so many people think investing is risky because they or we invest for capital gains. Sixth lesson. In most cases, investing for capital gains is gambling or speculation. Seventh lesson, So when a person, right, when he or she or when I says, I'm buying this stock, I'm buying this mutual fund, or this piece of real estate, then he or she is investing for capital gains. And 8th lesson, capital gains. This is what capital gains means, is that this is an increase in the price of the asset. So what is our asset? Is it stock, mutual fund, or a piece of real estate? So capital gains is an increase in the price of the asset. So in real estate, we often refer to as appreciation. 9th lesson. So for example, if you remember, so if we purchase 17 million of apartments, we could sell it for $25 million. So we have an appreciation right there, right? Because we were able to sell it for 25 millions. Now, when we sell it, this means we are investing for capital gains. So that's one type of investor. So when we buy properties and we fix or flip it, we add value to it, and then we sell it at the high price. For example, in this particular situation, we buy a real estate, a $17 million apartment, and we could sell it for 25 million. It appreciated, and we sold it for that price, 25 million. Then we are classified as a capital gains investor. So 10th lesson, investing for capital gains, we have to remember that we are being taxed. Okay, in USA, we are being taxed. So this is very important. We have to factor in the taxes that we have to pay. The second type of investor is an investor who invests for cash flow. So Robert says investing for cash flow is less risky compared to capital gains. 12th lesson, investing for cash flow is investing for income, right? We do get rents from our tenants, and it's called income, investing for income. 13th lesson, if I put my own money, okay, my money in the bank, let's say I put it in a savings account, and I receive 5% interest on my money, then I am investing for cash flow. 14th lesson. Now, while the interest in the bank is low risk, right? The bank is low risk. There is a problem with savings in the following. The return of our money is low. Next, the taxes can be, can be high, and our money keeps losing value. 15th lesson. When Robert purchased, when he bought that 300 apartment unit, so that's 300 units, Robert was investing for cash flow. He was investing for cash flow, the income. And the appreciation is just icing in the cake. Now, 16th lesson. The difference is Robert was investing for cash flow using Robert's Mr. Banker, Robert's bank. So when he used the bank as a leverage, that means he was investing for higher return on his money. Because remember, money, it's 80-20 loan to value, right? So Robert's money is only 20%, and the bank's money is 80%. So with the use of the leverage of the bank's money, he has higher return. And then Robert is paying less in taxes. Because why? He has the tax benefits. Because Robert solves his community's problem, which is the housing need. So because of that, Robert has better use of leverage. Now, let's compare this with the bank, okay? Let's put our money into a savings account. So if we want to get 5% interest of our money, we have to put in 100% of our own money, okay? Of our own money. Whereas if we use the bank's money to buy, for example, real estate, we only need, we only need 20% of our money, whereas the bank would lend us 80% to come up with 100%. So this is the use of leverage now. This is why Robert has better use of leverage. Now, I'm going to summarize this topic, the 16 lessons that I've learned today from Robert on the continuation of financial IQ number 4, which is leveraging our own money. And the 16 lessons that I learned are: first lesson, focus and not diversification is the key to more sophisticated leverage, which means higher return and lower risk. Focus requires more financial intelligence. Third lesson, financial intelligence begins with knowing what we are investing in, what we're investing for. So are we investing for capital gains? Are we investing for cash flow? So in the world of money, there are two things that investors invest. And these are, first, capital gain investor, or second, a cash flow investor. Fifth key takeaway, capital gains is another reason so many of us think that investing is risky, because we invest for capital gains. And in most cases, investing for capital gains is gambling or speculation. Seventh lesson, when we say, or when people say, I'm buying this stock, I'm buying this bond, I'm buying this mutual fund, I'm buying this piece of real estate, he or she or we say, we are investing for capital gains. Now, what is capital gains? Capital gains is an increase in the price of the asset. So the asset, again, could be stock, mutual funds, or piece of real estate. Capital gains, again, is an increase in the price of our asset. So that is appreciation. Ninth lesson, for example, if you purchase a $17 million property or apartments, and at some point in time, we could sell it for 25 million. So we have an appreciation of from 17 to 25 million. So there's appreciation there. Then Robert says we are investing for capital gains because we sold it, right? We have a gain of our money. Now, investing for capital gains in a lot of countries, we are being taxed. So don't forget that. We need to pay on the income, the gains we get from selling that property. 11th lesson, cash flow is the second type of investor. Cash flow is less risky compared to capital gains. Investing for cash flow is investing for income. So if I put my money in the bank, such as the savings account, and right now, because of high inflation, you could get a higher savings. CD would give you 5%. So let's say the savings account, your CD earns 5% interest. Now, Robert says we are investing for the cash flow because we get 5% return. 14th lesson, while the interest in the CD or the savings is low risk, the problem with the saving is in the getting the returns is low, the taxes can be high, and the money keeps losing value. It's depreciating value, or it's called a devalued, right? So your $1 is not $1. So your $1 could be 10 cents. 10 cents. That's 10 cents. Okay, just to give you an example, that's what it means, losing value or devalued. 15th lesson, when Robert purchases 300 apartment units, Robert was investing for cash flow. Cash flow is the income, the rents he was getting. 16th lesson, the difference is Robert was investing for cash flow using Robert's bank, this Mr. Banker, for higher return on his money. So remember, when Robert or when you and I use the bank, It's not 100% of our money. We use 20% if we're buying single family homes, or if you're buying multifamily apartments, they would require as high as 50% loan to value. So 50-50, 50 from the bank and 50 from your own money. So in this case, Robert was only putting up 20% of his own money, whereas the bank would be putting up 80% of the bank's money. So that is what it's called leverage. Robert's leverage of using the bank's money. And that's why it provides Robert higher return and paying less in taxes. Now, don't forget, because Robert solves housing problem in his community, he gets the tax benefits, right? He is providing the housing needed in his community. So in this several points that I shared with you, Robert has better use of leverage. So those are the 16 points that I shared with you today. Let me know what in the comment section below what you've learned. Now, are you a cash flow or a capital gain investor? So hopefully you learn from this, and stay tuned for more Alka and Ria show.
That is the key. Are you a cash flow investor or are you capital gains? Ria, thank you for sharing that, first of all. Just amazing. Wow. So point number 6, you talked about investing for capital gains, right? So that's either gambling or speculation. Now, maybe other people might be wondering as well that in a downturn market that we are in, when you are looking to sell your home, what is the implications? Could you share that with us? What are some of the implications that may occur?
Yes. So let's say, for example, you bought a property 1 year ago, right? Less than a year, or let's say a year ago during COVID 2021. So the prices, as you know, because we were told by the government to stop all our activities, and it took sometimes for the builder to build things, and the inventory was low. Not many people were selling because they were staying in their home. They don't want to get sick from COVID.
Yeah,
so what happens, the inventory of the single family homes, we're just using an example of single family homes, okay? The inventory was low. And because the inventory was low and there was high demand for properties, right? People were relocating from New York, from California, and they were flocking in, for example, in my place, Pennsylvania, right? So the demand is high, the supply is less. So the prices when I bought it in 2021 was very high. Now here, presently, because of the high inflation, the interest rate is very high. So not a lot of people are buying. Why? To buy a property, a single family home right now, I could be paying 8%, 9% interest compared to 1 year ago where I was only paying 3%. So that's a 6% difference. That could double or triple your monthly mortgage and your principal and interest. So because of that, not a lot of people are buying. So now there's an inverse, right? The demand is low. So if you don't have any people interested in buying your single family home, guess what? And you sank a lot of money for renovations, for flipping that property. Let's say you buy it $100,000 and you did a lot of renovation to make the place look gorgeous. Granite countertop, stainless steel appliances, you name it, all the bells and whistles are in that property. So you put in $100,000 worth of renovation. So $100,000 purchase price plus $100,000 of renovation, that gives us $200,000. And now at today's market, that $200,000 cannot be sold for $200,000 because why nobody's interested in buying? Because why people are scared. In fact, our mentor Grant Cardone said there was a lot of layoff. Google 15,000, Facebook 12,000.
Right.
There were a lot of layoffs just recently. So who do you think I would be interested in buying that property if there's a lot of layoffs? Of course not. Those layoff people will be renting. So who's going to buy that $200,000? So what happens to the flipper in a down market? They're going to lose a lot of money because we have no demand. There's no buyers out there. And that is why Robert says capital gain investor is gambling or speculation, because you can never time the market. Like this the Federal Reserve just increased 7 times. Can you imagine 7 times increase in the last 1 year?
Oh my God.
7 times.
Wow.
So that is gambling or speculation, because we have no control. But if you hold it long term, right now you're not a capital gain investor, you are now a cash flow investor. And you did the math before you purchased the property. Now you're able to rent that 100,000 for a 1,000 rent. You didn't put in a lot of renovation, because when you bought the home, it had, just original countertops, right? It was working fine. All you did was put fresh paint there and rented it out for 1,000.
And a lot of people say that you can control the market. You can never control the market. That's just a myth. That's just the wrong approach. You can control the market. It is what it is. So yeah, I mean,
that is correct. So if you bought that property 100,000 and you're able to rent that for 1,000, now you're a cash flow investor, because now you have just an average of 10% return. If you bought it for 100,000 and if you have the 1,000 rent, that's the 1% rule in real estate, you have there a 10% return, and that's without any of the tax depreciation, the cost segregation that you're going to be doing. That means you're going to be earning more returns. That is if you're investing for long term, which is cash flow, and that's income per month from your tenants.
That's great, Ria. And yeah, I mean, that was because that is a sticky point for most people, is that, okay, the capital gains, I need to be careful. I mean, you do need to be careful, right? But especially now in the downturn market, we don't want to risk taking that chance. But sometimes, that risk is a good way. The risk is good, because if you don't risk, you don't know as to what could there be a potential. There could be a potential, whether you're selling or you're buying, there is always the potential. So you have to have a minimal risk that is associated, and as an investor, we take the risk, we take that chance.
Educated risk. You're right.
Yeah, educated risk. You don't go and blindly do it. Right.
Yes, calculated risk. Yeah, that is why Robert Kiyosaki is very strongly keen to all of his, avid fans, to be investing your education into your own self, right? Because without investing in our education and we're just blindly deploying our money, then that's a gambling there too.
Exactly. So, I love that analogy, gambling or speculation, because even that too, like whether you're starting out as an investor or you are a seasoned investor, people still make mistakes.
Yes, we do. We're humans.
We're humans, exactly. But you know what? The question also comes down to is, what you said, you got to learn from a mistake. Once bitten, twice shy, that analogy is that, if you make the same mistake that you made, you invested so much money, X amount into that investment, and you lost. You lost because you went in blindly just investing. Oh, it looks good.
And the other thing I can share with that is, what insanity is? Doing the same thing over and over and expecting a different result. That is called insanity.
That's right, because it ain't going to happen. But you know what? Yeah, I mean, that was great, because the more that we can, really educate ourselves, financially, and, spending, borrowing money, lending money. These are the principles that too people don't know. And, we have to educate ourselves how to make the investments, where to spend the money, where are we overspending, and really calculating ourselves, especially now. 2023 is a year for most people. They want to, make some kind of a change. So Thanks, Ria, for really sharing this amazing knowledge. And friends, you know what? That is what we want to leave with you, is that, where are you right now? Where are you desiring to make the change? Because change will only come about once you educate yourself. Because without what we share with you, if you don't educate yourself doing your due diligence, you also need to say, okay, well, I need to budgetize. Where am I budgeting? Where do I need to budgetize? Daily, monthly, weekly? Budget. Where are you spending your money? Where is most of your money going? Where are you spending? Where are you overspending? So if you have a budget, then track on a spreadsheet is a perfect example, so that you are crystal clear as to what are you doing with your money. And so Ria shared, your financial IQ, you can only build on your financial acumen if you learn now. What are you doing? So we're gonna end right there, because we hope that you truly got a lot of nuggets from this segment. And Ria always shares amazing value, and that's what we want, so that Ria and we share the value with you, and you go and you implement on that, because knowledge alone is power, but power without implementation, well, then it's just prime knowledge. So friends, we hope that you truly got a lot out of this. We will see you the same time tomorrow morning, and make the rest of the day the best of your day.